Last week, we brought you IUL history and what it is, Index Universal Life Insurance. This is IUL month here on the Life Insurance Financial Education Podcast. Today, we're going to be talking about using IUL as a diversification tool in an overall financial portfolio. So welcome to the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
My name is Jing with Tax Exempt Millionaire Club.
And I'm Carlo with Net Wealth Finance.
And today we are talking IUL as a diversification tool in a financial portfolio. Essentially, when portfolio managers or people that manage their own finances, such as us, are doing that, we have to have some type of a hedge against market downturn. That's what we mean basically by using this as a volatility hedge. If in your overall financial plan, if the market loses 50%, what do you own that didn't lose value that you can rely on in order to prop up the rest of your portfolio in the short term and allow time for it to recover? That's essentially what we're going to be talking about here today. Traditional portfolio might include a certain percentage in bonds and a certain percentage in equities. If you just talk to your normal, regular financial advisor who wants you to invest everything in the stock market. Real estate investors are probably going to take a completely different tact. And then we have life insurance and high cash value life insurance and where that can play a part as well. So we're not going to be covering all of the other possible different ways that you can hedge against volatility. We're specifically going to be talking about how IUL can work as a great tool for that. And we're going to really dive into that here today. So I appreciate you joining us. Let's kick this off with one of the biggest reasons that we like to put money into IULs. And that's that floor of 0% that says we're not going to lose money. What can you tell us about this, Jing?
Sure, that's one of the fundamental hedge components. When we talk about floor, that means we actually will not lose value. The industry standard is using 0%, but some policies may offer 1% or 2%. The floor means actually when the market is tanked, say 18% or 20%, your cash value will still earn a 0% interest because your money is not directly investing in the index. So this becomes the fundamental of the hedge. You will not lose money, which is one of the key components, never lose money.
Yeah, it's definitely difficult to not ever lose money. I think that would be great. But we do have to hedge against that. And that 0% floor, not actually having money invested in the market that's protected when kind of everything else is going down, is massive when it comes to something serving as a volatility hedge. Now, the IUL itself has a particular mechanism that does allow us to participate in those upsides without the downsides. What do we call that?
So there's this effect, and it actually also ties to that 0% or 1% floor, is this stair-step effect. So we never are stepping back or stepping down on the steps. We might have the ability to stay flat in a given year where the market is going down, let's say 30%, but we'll stay flat. And then the next year, that market might bounce and rebound, and we can get that big recovery. However, we never experienced that big drop. So if it was a 30% year and you are directly in the market, you will have to gain 30% just to get back to zero. That is one thing with an IUL. When you have that floor, we can have that stair-step effect where that never happens, where we have to get back to where we were. We can always just keep stepping up and stepping up and stepping up. And that really is a powerful thing when we're talking about a volatility hedge and not experiencing that big downside.
Yeah, it's really those big downsides that everybody's afraid of and the thing that we really want to avoid. But the reality is a 0% floor or even a 1 or 2, depending on what the insurer is offering, that's valid and valuable anytime the market is down. It could be down 1% or 2%. and you still have a better position going into the next year in the IUL than the actual cash that was in the market that did go down. So I just wanted to point out that we talk about protecting against these big, massive downsides, but really any particular drop is protected inside of here. And almost every year we do see some type of a drop that happens, and it really creates a lot of uneasiness for market investors if they're overexposed. Now, how does this happen? Is it magic inside of the IUL that makes it possible? Do the insurers have some special magic way to do this that nobody else does? Not really, but they do have a general account with actuaries and people that are there and specialize in hedging a portfolio that are very, very good at making money. And they are mostly in long-term bonds, and they know almost to the percent or fraction of a percent how much money they're going to make over the next year. That gives them a budget. As an example, this is how they might engineer this return profile that allows you to get a 0% floor, but still have upside potential in the market. If their budget is $100,000, they're going to take 5% of that, and they're going to use that to go buy options. And the general fund in their account is going to grow 5% over the next year. So by the time they get to 1 year from today, they are back to $100,000. And then the next year, they can take another 5% and do it again. So each year, they can offer you 5% of a budget to go buy options with that give us upside potential with what we own with the insurance company. And then they just recoup it using their general fund account. And then they make that budget available again the next year to you. This is something that you could do on your own. Any individual investor could put together a plan like this on their own. But it's a bit more complicated. It's definitely harder to do. And it's also tough to be an individual investor and not get caught up in ups and downs in the market swings and deviate from whatever plan you have. So being able to utilize the insurance companies for this aspect that they specialize in, and they have an excellent team that manages these options that are available to you and ensure that they have a budget that regenerates every single year so they can continue operating it, is like, it's just special. It's a unique thing that they offer that is really hard to duplicate outside of these insurance companies. Now let's look more into a critical evaluation of the IUL as a volatility hedge. How does it actually work in different market scenarios? Let's start with a bear market. What can we expect the IUL to do in a bear market, Jing?
So in a bear market, nobody wants to see the bear market, but in the down market, the IUL actually, it can perform its primary hedging function very effectively. We talk about the 0% floor, which your cash value will preserve its actual value instead of you will experience the direct loss due to the market decline. And this specific feature in the bear market can be super effective. We all want to accumulate. We all want our asset to go up. So this scenario where the product design actually can provide very tangible benefit in the bear markets.
And I think that when we're in a bear market, knowing that your downside is protected makes it really easy to own this product during that time period where you might otherwise be questioning everything else that you're invested in if it's in the market and dropping at whatever rate the market's coming down.
And talking about the peace of mind this product can bring you when everybody's losing its value.
That's right. Now, how about in a sideways or just a volatile market?
So really, there can be different scenarios with sideways and volatile markets. And we've seen some of that over the past few years, and some strategies haven't been as good, but some have been strong. So one thing, like I previously mentioned, with the stair-stepper effect is when there might be modest losses. James was mentioning that modest loss year, and then it bounces back a little bit, and then maybe it's going up just slightly, and then it goes back down. So when those sorts of things are happening, especially in a product that might have like a lock feature, you might have the ability to lock in some gains in a given year and the market goes back down, we have the ability to control some aspects and control for that volatility in the product, but the product inherently itself controls for this, and you can lock in gains even if you don't touch it. So that's where you can maybe have that guaranteed 1% and still experience a little bit of upside and steady growth in these sideways or volatile markets.
Yeah, that stair-stepper process that locks in the gains. Every time you get a positive return, it's not going to go back down. Sideways market is perfect for that. Now, everybody's concerned mostly when it comes to a bull market, because that's where we lose all of that upside potential that's basically unlimited in the actual market itself. And this is where I like to say it's a main reason why we don't look at the IUL as like the magic tool. This is not the only thing to own if you want to optimize your returns. You don't necessarily want to have all of your money invested in IUL and think that you just own the best tool out there for gaining wealth. That's not really the case, because we have participation rates, caps, and spreads that might actually limit your growth in relation to what the actual market is doing. You can look back on studies, and if there is a cap of, say, 10% over a certain time period, you might lose out on a number of potential upside in the actual S&P 500 where it performed way over 10%. You're not going to participate in the big drawdowns in that scenario, and that will make up for some of that, but most likely you'll underperform the actual S&P 500. Okay, we know that going in. Like, I like to think of it as money that we have actually invested in the stock market. Like, what's your sleep number? How much are you comfortable with having at risk going down and you can still sleep at night? If you can't sleep at night when the market's going down, it's too high. You got too much invested in that particular area that's not protected. And so we need to diversify a bit, utilize a volatility hedge, have different types of investments that aren't going to be going down so that we can continue to basically have good mental health in all market environments. So yes, we may end up missing out on some upsides in a bull market, but we can get significant growth even inside the IUL through a number of different index options that are available. There are a lot of uncapped options that give, and we've seen 10, 20+% returns in any given year just in the recent history here. Okay, so mentioning that, let's talk about those opportunity costs just a little bit more when it comes to cap rates and participation rates.
Well, the cap rate and the participation rate, those are direct costs from the carriers. The insurer effectively sells off the market upside potentials beyond a certain point to finance the purchase of options. That will create the 0% floor we were talking about. A lower participation rate, which below 100%, further dilutes the return credited to the policyholder, which the cost can be hefty sometimes.
Yeah, it all depends on what the insurer has access to. And are they paying extra to have an outside entity manage their particular options, or do they have their own trading desk where they can create these options? And then you also have insurers that will make special relationships with large banks to buy options that aren't otherwise available on the market. So all of those come at a particular cost. Nobody is going to give these out for free, and that potentially limits that upside. What else can we say about being inside the IUL that might be considered an opportunity cost or just a cost in general in relation to investing in the actual market?
So in direct market investments, if you're using an index strategy, maybe like an ETF with the S&P, a good portion of the historical returns on an S&P ETF or mutual fund will be from dividends and those reinvested dividends. Probably somewhere around 1% to 2% of that total return is in those dividends. Within an IUL, you're not going to have a dividend on top of the market return. You're going to have access to various crediting strategies that may underperform what that total return is in a given year, or maybe outperform it some years. But whatever the case, you're not going to be getting access to the dividends that a particular index is paying, even if your underlying index is something that is a dividend-paying index.
Correct. Now, as an experienced options trader, I would point out that dividends do get factored in to future cost of options if the dividend is known. Now, they also use expected dividends to help price options. So even though you're not actually getting the dividend, there's a good chance that that dividend is priced in to the price of the options. It does help with us getting a particular return that might be similar to what the market might be offering. The last thing I want to point out about this is that volatility drag, where we may be missing out on some potential upsides. So you might have a really big bull market that just shoots up really fast, and you're going to be limited in some way that you don't get to participate in the full growth of that market. We have that as a trade-off that protects us from that downside in the really low years. So we're going to avoid the big ups and the big downs, and we're going to kind of be happy bouncing around in the middle. That's like the ideal thing for a volatility hedge. That is what it is meant to do, and why we like the IUL to serve that purpose. I hope that this was beneficial to you in helping you understand a lot of the things that we look at in the IUL when utilizing it as a volatility hedge in an overall financial portfolio. If you have any questions about this, feel free to reach out to us. You can leave comments in the comment section if you're on YouTube, but you can email us and you can reach us through our website if you have any questions that we may not have covered as far as this topic goes. Do either of you have a call to action for our listeners this week?
It's time for this week's call to action.
I think we talk about don't put multiple eggs in one basket. I would encourage all of our audience to really take a look what are your eggs in your different buckets. What are the risk factors? How much return you're getting from each egg or each account? It's very important to really take a look how you could use IUL or whole life or any kind of life insurance product to hedge your volatilities.
And I would just add to that, James mentioned your sleep number, or whatever, the market taking a hit for a certain percentage. What would make you okay sleeping at night with how much is tied to that directly? But I want you to also think about, what about 10 years from now, or 15 years from now, or the year you're about to retire? Would that number be the same as what it is for you now? And if it's not, if let's say whatever it is 10, 15 years from now, the percentage allocations that you have, how you are looking at your portfolio, what you're going to do with it, then exactly what Jing said, think about some of these hedging tools. IUL can be a great one. Whole life can be a great one. There are others as well, but I want you to make that assessment for yourself.
Along with making that assessment, definitely consider that when it comes to life insurance and utilizing it, the younger you are when you pick it up, the less expensive it is, and the more years you have ahead of you to have it compound and grow. And you get to take advantage of that compounding growth with a very, very low expense. So definitely think about where you might need a volatility hedge in the future, near retirement, and think about starting to plan for that today. Next week, we're going to be talking participation rates, caps, and spreads in the IUL, and basically everything you need to know about it as we continue IUL month here on this channel. Appreciate you joining us. My name is James Barber. I'm your Oregon Cashflow Pro, and you can find me on YouTube at Oregon Cashflow Pro. I design and sell high cash value life insurance and annuities with clients across the country.
And my name's Jing. I'm your host of Tax Exempt Millionaire Club. You can scan the QR code to join the free school community. I also have my YouTube channel, the same Tax Exempt Millionaire Club. I'm also licensed in multiple states. Happy to connect with you anytime.
And I'm Carlo Vaquera. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. We'll see you next time.
Thank you.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.